Right, I made that 12:30 by my clock. So good afternoon, everyone, and welcome to this pension webinar. You'll note on the screen it says Pension Awareness Week. That was actually technically last week when we delivered the first of this slide deck, but the whole reason why we were doing these webinars at AVC Wise was as part of that initiative. It's where the industry reaches out to all its members, whether that's public sector or private sector, to try and engage and sort of educate them all things to do with pensions. So welcome to this webinar entitled, What Does Your Pension Statement Tell You? My name is Jonathan Kempson. I'm one of the workplace implementation managers at ABC Wise. Joined them in 2018, but prior to that, I was 20 years from the Prudential, and my time at the Pru was predominantly spent dealing with LGPS matters, so dealing with employers and, of course, members, people like your good selves, talking around things called AVCs. And, of course, what your respective employers have done, have launched the latest version of AVCs, which are the salary sacrifice shared cost AVCs or shared cost AVCs. More about that a bit later, but what we're going to principally focus on is your annual benefit statement. Some housekeeping before we go any further. The webinar is factual information only and doesn't constitute financial advice, and everything is based upon our current understanding of taxation, legislation and scheme rules. So what are we actually going to be covering this afternoon? Well, firstly, we want to help you understand your LGPS pension statement. What we're not going to do is go through it line by line, box by box. Pension statements are pretty dry affairs at the best of times. Really what it's about is taking some of the numbers which will be in your annual benefit statement and then extrapolating that information and thinking about what the repercussions are. But we'll certainly give you an idea as to what the different sections are, how they add up, to try and make sense of what are lots and lots of numbers on an annual benefit statement. But at the end of the day, when you boil it all down, really the only key numbers you need to know are the grand totals in terms of how much you're going to get and when. And then, of course, we will also look at ways you can actually try and bridge any gaps you've got, or if you simply just haven't built up enough pension, what options are available to you as a member of the local government pension scheme. So, excuse me, without further ado, let's go straight into the annual benefit statement. Now, there are always lots and lots of numbers and lots of text there. But what you'll see is the key date, which always crops up, is the 31st of March each year. That's when the pension fund will sort of lift the bonnet and say, look, this is how much pension you've actually built up. And what it will do, as you can see on the screen here, is it actually breaks it down also into the current section, which you're all in, which is the care section, the career average revalued earnings section. But also it takes into account whether you've got membership under the former final salary sections. And I'll show you a slide to sort of break it down a bit more graphically very shortly. But essentially what it's doing is it's saying, look, at that date, the 31st of March 2021, this is what it all adds up to, and it will break down the final salary pension if you've got any, and also the career average, and it will give you this total yearly pension. And it will also tell you whether you've built up an automatic lump sum as well. But you'll only have built up an automatic lump sum if you've got service under one of the final salary sections, the 80th scheme. Now, of course, we can see the numbers on this sort of hypothetical extract here, £3,527 odd annual pension. That doesn't mean that that person would have got that necessarily on the 31st of March 2021 if they retired, though. Why? Well, because the earliest you can actually cash out a local government pension under normal health is 55, and the latest is 75. And in between that, of course, you all have your own normal pension age. And moving forward, your normal pension age is the higher of 65, or your state pension age, and that depends upon your date of birth, doesn't it? So what this, and as you know, if you cashed in your local government pension, and even if you were between the ages of 55 and 75, that yearly pension isn't necessarily what you'd get, because if you were taking your pension before your normal pension age under your own volition, there'd be reductions. So this, number which says at the 31st of March 2021, that's not necessarily what you'd actually get if you could, even if you could have possibly retired on that date. It's literally saying, look, given your service, given your current salary, this is hypothetically what's under the bonnet on that date, not necessarily what you're going to get. And what, if any, automatic lump sum. And what it does is, as I said, it splits it down to the two sections which are currently in the care scheme, but also the former final salary sections as well. And then, of course, what it then does is it projects it all forward as well. So it tells you, and this is actually compared to other pension statements out there, a lot of them don't actually give as many numbers as you do under West Yorkshire Pension Fund. But it tells you, what if I retired at the end of next month, 60th, 65th, or my state pension age. And it will produce all these sort of cascade of these different numbers. But all it's doing, whatever that projection is through to, is it takes your current salary, whatever that is, and just extends the service up to those respective periods, 60th, 65th state pension age. Now, of course, those of you who are still a way to go until your normal pension age, your state pension age, you're going to look at these projections with a pinch of salt, aren't you? Because, of course, the hope and ambition is that your pay is going to go up between now and when you get to there. You might take on a different role in LGPS, role with more responsibilities, bigger pay, and of course, the further you are away from retirement, the less realistic this forecast is going to be to whatever benchmark they're looking at. As I said, it's all based upon current pay, which, as I said, we hope that will increase to a certain extent. If you are relatively close to your retirement, well, actually the forecast is going to be there or thereabouts. Tends to be the case that pay, normally speaking, is fairly static in the run up to retirement, or even if you are reducing your hours now that you're in the career average scheme, that won't have much of an impact on what you're finally going to get, because the way you build up your pension benefits now is slightly different. But what we're saying is essentially the forecast is literally current pay projected forward to whatever date there is there. Now, just to explain around, or perhaps a cleaner way of showing what that means for LGPS members, is for all of you. So it doesn't matter when you join your respective employers, for all of you, service from the 1st of April 2014, just to be really clear, means all of you are in this career average revalued earnings scheme, the care scheme. And how that works is that you get your salary, whatever that is, and you get 1/49th of that salary. That's the amount of pension you've just banked for your future, for your retirement. This is this guaranteed pension for life. And so as the years go by, of course, you move on to the next year, whether you get a pay award or not, it's 1/49th of the salary that year. So you're banking these layers of pension. They are then revalued by CPI, Consumer Price Index. And I tell you what, you'll be very pleased about that, because if you've been watching the news the last few days, we've got something at the moment which the Bank of England doesn't really like, and that's something called inflation. We're starting to see that really starting to bite. If you filled up your car with fuel recently, or you're looking at your energy bills, well, watch this space, all that stuff shooting up at the moment. So at least when it comes from an LGPS perspective, your pension is going to keep pace with whatever the Consumer's Price Index is. So that's a great, really, really important feature. And that's good for your career average earnings, that they are revalued like that, because you get to retirement, however many 49ths you've got revalued, that gives you your annual pension at retirement at your normal pension age, which moving forward is the higher of 65, or your state pension age. And of course, your state pension age depends upon your date of birth, doesn't it? And those of you, as I said, got service before April 2014, well, between 08 and 2014, you were in the final salary section of LGPS, which were known as the 60th years. So how that worked is that if you worked 1 year full time, you'd built up 1/60th of whatever your final salary is going to be. Now, the good news is that final salary is still linked to your pay as you get close to retirement now, it didn't freeze. They still retain that final salary link, but obviously what is frozen are the number of years and days you built up. So that ran for 6 years, that 60th scheme. So if you work full time, it's 6/60ths of final salary. Now, of course, if you are part time, what they do is they do pro rata down the number of years and days you built up over that 6 period, but it's multiplied by the full time equivalent salary of your position. So that gives you your pension at retirement. And then for those of you who got service before April 2008, you were also in another final salary section, which were known as the 80th years. So again, 1 year full time, 1/80th of whatever your final salary is. Again, prorated down if you were part time, but that gave you pension plus, and it's always a plus, the automatic lump sum. So when we looked at the previous extract of the pension statement, you have only got an automatic lump sum in local government if you've got service in the 80th years. Okay, and whatever that lump sum is, you have to take that. That's projected, or that's actual, money which you have to take. You can't convert that back into pension. It is what it is. It's tax free. So hopefully that gives you an idea as to how that's why they give you all this detail on the annual benefit statement. Now, of course, you can take up to 25% back as tax-free cash, though. So that's considerably more than those of you who've got an automatic lump sum, whatever that number is on there. You can take a lot more out as tax-free cash. And even if your number's 0, you've got no automatic lump sum, you're still entitled to take 25% out as a tax-free lump sum. But here's the really important point on your annual benefit statement. It takes, because it will show you if you have a maximum amount, because as I say, you're allowed to take 25% out as tax-free cash, but whatever that number is on your annual benefit statement, they've assumed that you've cancelled your pension to realise the 25% limit. Okay, those of you who've had the wisdom to do some additional saving into these things called shared cost AVCs, these are the extra pots of money you build up with the PRU. You can actually use that as part of your 25%, but on your annual benefit statement, it never shows whether you've got an AVC or not. It just assumes this is your standard pension. Oh, and by the way, this is the maximum lump sum you take, and cancel some of your pension to realise that. You always get a separate statement on AVCs from the Prudential. It's actually only at the point of retirement they can chuck it all together, and you can, well, where a lot of members go with it is they use their AVCs back as tax-free cash, because as you see on the screen here, they'll always allow you to take up to 25% as tax-free cash. So you get your pension at retirement. For every £1 of pension you give up, so this is the exchange rate if you want to call it that, or commutation rate, for every £1 of pension you give up, you have £12 in tax-free cash, up to a maximum of 25%. My point here is that if you've got a shared cost ABC pot, that can form part of the 25%. And then maybe you don't have to damage your pension, because the mistake some members might make is that they look at this and they say, oh, well, I see a nice big lump sum there, and I've had to obviously damage my pension. They might think that that's a good deal. Well, it's only a good deal, really. It depends how long you live in your retirement, doesn't it? But if you looked at an average life expectancy in retirement, you've got to ask yourself, was that the right thing to do, to give up that £1 of pension to get a quick win in the cash? Because you absolutely you recognise that £1 was guaranteed income for life, month in, month out, year in, year out. It's never going to run out. You've got to 100, still being paid. But here's the really important point, and especially with what's going on at the moment, is that £1 was index linked, and it was going to go up year in, year out. I mean, your last 10 years has gone up about 20% LGPS retirees. So that £1 was going to grow. And if you're going to be around for another 20, 25 years by whatever CPI might do in the future, that might give you a better return rather than taking for the quick win on tax-free cash. As I said, though, a lot of you, though, will say, well, hold on a minute, here's my light bulb moment around my planning for my retirement. what if I want the best of both worlds? What do I want to keep my very valuable LGPS income, but actually still grow my tax-free cash at retirement? And then if you put money into things like shared cost ABCs and you cash that pot out with a PRU at the same time as your main scheme, then so long as that PRU pot fits inside the 25% limit, eureka, you can have that out as tax-free cash. And that is unique to, you're the only public sector scheme where you can do that. So absolutely worth considering that strategy, given where interest rates are at the moment as well. What I'll do actually, why don't I just pause before I actually go into the case study, because I can see, I think we've had 3 questions in. One of them was a comment, I can't hear anything. That might be someone who's unfortunately not on Chrome. Let's have a look. Let's pop this question in here. Gisela has asked, will the slides be circulated to all attendees? Well, I think I mentioned at the beginning, all the slides are in the chat box. So if you go into the chat box, you can click on there and download the slides for yourself. Then Neil's asked, do the projections factor in the adjustments for leaving before your retirement age? No, they don't, Neil. That's the whole point. You know, all they assume is you stay on current pay and you go through to your normal pension age. I mean, if you're talking about, a lot of you will be able to go in your pensions portal and do estimates before your normal pension age. So if you're running estimates off the system, then they will factor in the reductions. But yeah, the ones which go through to your normal pension age, well, it assumes that your pay stays the same, your service goes through to normal pension age. But if you're doing self-service through the pensions portal earlier, then it will adjust that. Richard's asked, how do you calculate how much maximum cash you can take? Yeah, good question, Richard. We basically at AVC Wise, if you get a projection as to whatever your local government pension is going to be at the point you're thinking of taking it, we can actually cleverly work it backwards and say, well, if you go down the route of shared cost ABCs, this is the maximum you can have in it and take it all out tax-free, and others with the 25%. How you work it out high level yourself is you get your LGPS pension, whatever that's on track to be, because when we retire, we're all measured against something called the lifetime allowance, and this should be on your annual benefit statement as well. So the taxman wants to know basically how big all our pensions are, and if it's over a certain amount, £1,073,100, you're going to get into punitive tax, which is not a good place to be. So how do they value my LGPS pension against this lifetime allowance thing? They take my projected pension and they multiply it by a factor of 20. Now, whether they think I'm going to live 20 years in my retirement, it's not quite as simple as that. That's just the agreed factor which HMRC use to value it against the lifetime allowance. So if my LGPS pension was 10 grand a year, then it's worth 200,000 towards this lifetime allowance. Plus, I then add in any automatic lump sum I've built up in LGPS for my service in the 80th years, plus whatever the value is of my shared cost ABC pot, my ABC pot, when I get to my retirement. And then technically in that example, you'd have 3 pots which you add together, and it's 25% of all 3 you can have out as tax-free cash. So if that sounds a bit complicated, get us to work it out for you is a simple way, Richard. Derek's then asked, if you choose to add your AVC to your pension pot, how long does this process take? I think, are you talking, I don't quite understand the question, Derek, but if you want to amalgamate it, I guess, at the point of retirement, see, whenever you retire, whenever that is, the pension fund, there's paperwork to fill in. And what will happen is the pension fund will get an up-to-date valuation from the PRU at that point in time as to what your pot's worth, to then do all this 25% calculation. What you can't do, or if you're then deciding to take it as tax-free cash, or maybe you want it as income, obviously then they've got to let you know what those respective numbers are. But at the point of retirement, it's all fairly seamless. Obviously, there is a bit of a delay. If you've made your last AVC payment in your last pay slip, then of course that takes a while for the money off your last pay slip to land with the PRU, and then it's got to come back to the pension fund as well. So there can be some delays in sort of payout there if you're running up to the last minute there. But as I said, ultimately all the calcs are done from the pension fund at the point of retirement. Right, well, last question before we do crack on. Linda's asked, how do I work out how early I can retire with sufficient funds? I'm 55. It all sounds complicated. I think I can totally understand why you feel like that, Linda. I think it is with all this stuff. But I think how you go about it is, what you've got to do is use your annual benefits statement as a starting point for trying to plan your retirement. So the first question, not that I'm your advisor, because I'm not, but the first question I would be saying to a client, if I were an advisor, is, well, when do you want to retire? Do you want to work through to your state pension age? That'd be the first question. Yes, no, well, I don't mind, or okay, well, if you want to go early, why do you want to go early? Because that gets the root of what drives you. The most powerful question a financial advisor will ever have for his clients or her clients is why. Because why gets inside your head as to why something important to you. And then we need to look at the hard facts and then the soft facts. So the hard facts are, hard facts is, well, do you want to work through to your retirement? How much money do you want in your retirement? Now, that's a very difficult question to answer, because when we're retired, we don't need, in theory, as much money. If we've been used to commuting, I know some of us are working from home now, but if you're a homeowner, you're paying off a mortgage, then you need less money. But actually, don't underestimate how much you're still going to need when you're retired. You've got to heat and light your home, and with energy bills where they're going at the moment, that's a bit of a worry. Are you going to run a car in retirement? What do you want to do in retirement? You've got hobbies, paint a picture as to what a monthly budget looks like. So you've got to make some assumptions yourself as to what you think you need as an income. Then you've got your annual benefit statement. It's got those numbers on it through to your normal pension age. If you want to work to your normal pension age, assuming the same pay, you know what that number is. You can actually get estimates if you want to retire earlier than that normal pension age, to see how much income that is versus what budget you think you need. So it's a bit like sort of having a word with yourself and getting the hard numbers first off my annual benefit statement, or getting some estimates if I want to go earlier, then thinking about how much money I truly need in my retirement, what I want to do. But I can tell you one thing, I think the vast majority of us underestimate how much money we might need in retirement. And a lot of people think that just by being in the local government pension scheme, it's going to give you enough money for your retirement. It's a really good scheme to be in, don't get me wrong, but it's not necessarily designed to make you a wealthy person in retirement. So a lot of us will have what I call a planning need to do additional saving for our respective retirements. And that's why it's important to understand this annual benefit statement and what options you've got to try and improve things. So I hope that helps in some way, Linda, but start that journey about looking at your annual benefit statement. Do you want to work through to then try and pull a budget together, what you might need, your monthly bills, etc. And then just be honest with yourself. Do you think you saved enough for your retirement? What is that number? Remember, at your state pension age, you get your state pension as well. You get a separate state pension forecast as well. You've got full NI contribution. That'll be sort of eight odd thousand. Maybe not the full state pension, because you're in a contracted out scheme for a number of years, but you can get a separate state pension as well. And if all of that stuff is a bit too much, then for you, and you're after some advice, then you do need to talk to a financial advisor. Okay, right. Let's get back to the slides then. So we've got Sarah here. Let's have a quick look at the case study. So we've got Sarah. Let's assume her retirement age, given her date of birth, is 67. Let's imagine when she gets there, she's just over 29,600 odd pounds. Next thing the pension fund will do is look at, well, when did you join? So if you've got 1 year in the 80th scheme, that'll give you a bit of pension, gives you a little bit of a lump sum as well. You've got the full 6 years, so you must have been full time. 6/60ths, bit more pension. And then assuming in a forward-looking statement, you've got 18 years in the career average section. So it's 25 years overall, through to 67. Your annual pension then, Sarah, 14,900 odd pounds a year, plus a little bit of a lump sum. Not much, because you haven't got much in the 80th years. So again, annual benefit statement gives you the hard facts. There you go, Sarah. Is that enough? What do you want to do in retirement? Got hobbies? Do you want to go traveling? Not that you do much of that at the moment, but in the future, paint me a picture as to what you think your money is, and if that's enough, great. You got your state pension as well. But as I said, don't underestimate how expensive living is. If you want to go early than that, so we run another scenario where Sarah jumps off the boat 3 years early. This is when it starts to get interesting. Rather than 14.9, how about 10.8? Big drop for going 3 years early. Why is it such a big drop? It's a big old chunk just evaporated there, because it's a double whammy, early retirement. Number one, you're going to lose out on so many 49s, which is quite a big slice of the pension pie. But on top of that, then the pension fund, will actuarially reduce your pension, because they'll say, well, we weren't due to pay out until 67, so if you want it 64, we're going to take something off it. And then, of course, that becomes a keener conversation with Sarah. Right, okay, we're now looking at 10,800 odd pounds. Talk to me about how much money you need month in, month out to cover everything, and what you want to do in your retirement. Now, 3 years later, your state pension is going to kick in, so that will give you potentially another 8 odd thousand. But talk to me specifically around what the years look like between 64 and 67. It's very likely she'll need to do some additional planning, because there are lots of very, very solid reasons why you, me, all of us want to retire before our state pension age. It's just a question of whether we can afford to do it. So what options do you have within the scheme to try and boost things to be more tax efficient? You've got a couple of in-house options with LGPS. First one, you used to be able to do added years, buy extra service within the scheme. That ship has sailed unless you're already doing an added years contract. The replacement is something called additional pension contributions. This is where you're buying extra income directly from West Yorkshire Pension Fund. So how it works is that you tell them how much extra income you want to buy from them, up to a maximum just over 7 odd grand a year. And they'll tell you then, look at your age, your sex, and over what period you want to pay for that contribution, that contract, how much it's going to cost you. Technically, you can do it as a one-off lump sum. That'd be a big old check you'd have to write there. Most people spread it over through their monthly pay slip. But here's my point about buying APCs. They're not cheap. Why? Well, firstly, your employer is not going to contribute towards the cost of these things. When you do your normal main scheme, you pay your bit in, depending where you're on the salary scale. The lion's share of the cost is picked up by your employer. Around about 99% of your salary is what they'll pay, typical employer contribute. There's none of that with APCs. You're shouldering the whole cost. You'll get tax relief on it to help reduce down that cost to you, but you're paying the employer element. It is index linked, so that's good. But here's another key difference. When you die in your retirement, this APC will die with you. There is no survivors element to an additional pension contribution. Unlike your main scheme, if you die, then your other half gets up to 50% of the pension you were enjoying. That doesn't happen here. And they're not that flexible, because you're paying for this contract. If you want to stop it, that's fine. They'll prorate how much income you've bought up to that point. But then if you want to restart it, it's a whole new contract. Now you're a bit older, so it's going to be a bit steeper the slope to pay for that income. You don't get many members doing these things because of the cost. If you are going to get a quote from the pension fund to do APCs, please get your calculator out and work out, how long have I got to live before I get the cost of paying for this contract back? So what's my break-even age? On average, individual calculation, I need to stress for each and every one of you, but for most members, it's at least 15 odd years into retirement before you even break even. So if you die early, you lose, pension fund wins. Other side of that, you might start to win, but don't forget, there's a likelihood you're going to be paying some income tax on this income. So on a net basis, your true break-even period might be longer than 15 odd years. And that's really why a lot of members don't do APCs, because of the cost. If you are going to do additional saving, you are far, far more likely to go down the route of doing shared cost ABCs, which your employers have introduced for you. And the whole idea of building up that pot with the PRU is that if you cash it out at the same time as the main scheme and it fits inside that 25% limit, have it all out tax-free. That's really unusual. Paying into a pension pot and you get the whole thing back tax-free. Yes, you can, up to your 25% limit. So don't get to retirement and say, oh, I could have done one of those things. You can potentially shelter thousands of pounds in these things perfectly legitimately and boost your wealth at retirement. No one tells you what to pay into the account because it's your account, and members really like that flexibility. Minimum contribution, £2 a month. Maximum, some of you can go as high as 60-odd%. You'd be surprised what some members pay into this as they get close to retirement. Yeah, they start thinking outside the box. How can I fund larger contributions? I'll tell you what I'm going to do. I'm going to live off that savings account with my money going up in smoke now that inflation's at, 3.49%. How much am I getting on my deposit account now? 0.01%. Let me have a little think about that. If I don't need access to that money until I retire, I'm far more likely to try and crank up my shared cost ABCs, strip it out of my monthly salary, because with that, not only am I going to get tax relief for whatever I put into that account, I'm now going to get national insurance relief as well. Given the fact that your personal allowance, how much you allowed to earn if we start paying income tax, did you know that's frozen for the next 5 years now? A little one hidden in the spring budget there, if you didn't pick that one up. What that means for you and I is that if any of us get any type of pay award over the next 5 years, we are going to pay more income tax. Fact. The other fact is that, as you've probably seen more recently, the government will be putting up national insurance. That's the proposal with effect from next April, another 1.25% on the NI. So that's going to give us a sort of tax burden not seen much since Second World War. I truly believe we have to pay taxes, of course we do, to support vital institutions, but if you truly understood the level of what I call direct and indirect taxation, you'll probably send a shiver down your spine. How do you actually protect or plan effectively for the future then, given these headwinds? Well, the answer is very clear. You put some money into shared cost ABCs because it will shelter you from income tax and national insurance, and then potentially back as tax-free cash. £100 if you're a basic rate taxpayer into that pot will only cost you off your pay slip £68.12 a month. You've just made 46.8% yield on your money before it's even invested with the PRU. Now, of course, those things can go up and they can go down, and yes, you can get less than your £100, but Prudential is going to have to do an appalling job with your money before that happens. Such is the level of recognizing that power of NI relief and income tax relief on these things. And of course, if you're interested in these things, the AVC Wise website has a calculator. It doesn't matter whether you're basic rate or higher rate or how close you are to retirement, you can go click on this calculator and see what the numbers mean for you, because you can actually click on the tag England and Wales, put in your tax code, put in your salary, whatever that is. Well, by the way, any of you at 40% tax, absolute no-brainer, subject to limits, of course. You can make yourself even a basic rate taxpayer by doing these things. And you can put in the gross amount you want to put in, £100 a month. It'll work out what the net cost is for you. And it can also do a projection through to, well, if I did that then for 3, 4, 5 years, potentially what could my pot grow to? Our calculator assumes that the underlying growth after any charges from the PRU is 3%, that's realistic unless you're in Pru Cash Fund, where you're not getting that return at the moment, but you still do it because your £100 only costs you 68, even if you're in Prudential Cash. Further resources after today, we do lots of webinars for more details on this. We've got the calculator, we've got bite-sized videos. Log into your AVC Wise account, and you can even read all the frequently answered questions on shared cost ABCs for your respective employers, and comprehensive across the board questions there. If you're after main scheme information, I just want to understand a bit more about my main local government pension scheme. I get my annual benefit statement, or maybe there's aspects I don't, and I need some more generic explanation around that, then lgpsmember.org is a great website for you to go to in England and Wales. Now, if your question, though, is, well, hold on a minute, I'm looking at my annual benefit statement, and I don't think the numbers ring true for me, then you need to go back to the West Yorkshire Pension Fund. Now, remember, how it all works is that the West Yorkshire Pension Fund is reliant upon your respective employers sending accurate and timely data to them to produce your annual benefit statement. Guess what? Sometimes the data might not be quite correct. So do have a look at those, that statement in full. And if there's something on there which you don't think rings true, then get in touch with West Yorkshire Pension Fund. Now, a lot of you can do that through your own portal, where you can go online, because gone are the days really of paper now. It's all electronic, or just pick up the phone to the pension fund. But certainly generic information is lgpsmember.org. Last slide before I come back to any final questions and comments. In terms of what you do is a reflection of looking at the annual benefit statement. Look, if you need any help with shared cost AVCs, then you can talk to AVC Wise, and there's different ways you can do that, through email, through live chat. We've got a help desk, we've got the knowledge hub for the calculator, frequently answered questions. But you're coming to AVC Wise because you want some help with shared cost AVCs, in a nutshell. If you're actually after help with your main scheme, because actually I've looked at that, the numbers don't look quite right, or I've got a query around my annual benefit statement, you can see I've put the link in there, My Pension. So it's mypension.westyorkshirepensionfund.org.uk, and you log in as you, and that's your sort of effectively your self-service thing. So raise it through that channel if it's anything to do with your annual benefit statement. And then lastly, if you're just after some generic information, well, how does LGPS work again? I just need a recap on the 80th, 60th thing, the career average thing. Then you can go into the lgpsmember.org website. That is, as I said, a comprehensive website for all LGPS members in England and Wales. Right, let's get back to any final questions before we wrap up today's webinar. So Deepak's asked, how does saving into an AVC work with the new NI tax burden? Is there any extra benefit? Well, we'll wait for all the detail to come through, Deepak, but the expectation is that obviously NI is going to go up. The burden would go up then. You're going to be charged more NI than what you are currently. So how do you do that? Well, actually, if you're doing things like AVCs, that's being stripped out of your pay before the taxman gets his hands on it, basically. So the anticipation is you'll get full relief on that tax and national insurance. Leslie's asked, will the increase in national insurance contributions have any effect on the shared cost AVC? Well, no, because you're either doing them at the moment or you do them in the future, Leslie. The whole point is that because it's done through salary sacrifice, it's removed that money. If the more you do into a shared cost AVC, then because it's done through salary sacrifice, bar £1 of it, it brings your headline wages down, and that's where the tax and NI savings are made. So what you've put and what you've sheltered in your shared cost AVC then is out of the taxman's grasp in that sense. Claire's asked, can you please provide a link for the pension calculator? Right. Well, how about this now? This will test my multitasking skills here, Claire. Let me try and I don't know whether that's going to work. Let's just try something here. I'm actually, because I had to dual screen, see, so I've got two screens, the one you can see with the contact us, and let me see whether I can actually on my other screen do this. No, I haven't done this one before. I like a challenge. Let's copy that. If I then go into that, there we go. I think that's gone in the chat box there. So under my initials, because I have another login as well. So you should avcwise.co.uk/knowledge hub. So that should be in there, Claire, for you and anyone else. Cool. There's some good questions coming in there. Right. Neil's asked. Yeah, and this is a pertinent question as well. Not for everyone, but it is something just to be aware of. What happens if you exceed the lifetime allowance? So, as I said earlier, all of us are assessed against this. How big are our pension pots? And they want to know how big your LGPS one is. Now, if you're a very long server in local government and you're a more senior member as well, then you might be a lot closer to that lifetime allowance and potentially in some cases might even go over it. So what happens if that happens? Well, you get into punitive tax. And to kind of just to be clear, if you had anything as a lump sum over the lifetime allowance, you have to pay 55% income tax on it. Ouch, it's designed to hurt. If you took it as income, you'd have to pay an additional 25% income tax on top of whatever your marginal rate of tax was. So, if you're at that level of benefits, your chances are you're probably still a 40% taxpayer. And then on top of that, you pay another 25% income tax as well. So it's going to hurt, Neil. There are various ways you can do to, slow down. If you're getting close to the lifetime allowance, you can, dare I say, some senior people, long servers have even moved into the 50-50 scheme, which was not designed for high earners to do that. But that you pay half, you get half in terms of your pension accrual with the LGPS. That slows down the actual progress towards that. And then Neil asked, yeah, great. Yeah, I think you might have read this, Neil. I don't know whether you're testing your own knowledge or not. Or you're asking, does the lifetime allowance increase yearly? I wish it did, or a lot of people do. Well, not me. I'm not going to get anywhere near the lifetime allowance personally, but it's been frozen for the next 5 years. That was another sneaky little thing in the by the Chancellor. So expect more people to exceed the lifetime allowance. It's frozen now. When it first came out, it started at 1.5 million and it went up to its peak 1.8 million. And then what happened is they found the reverse gear and it's been going down the slope. And anyway, we're stuck now at £1,073,100. Hopefully it might increase in the future, but I wouldn't hold your breath. Certainly not for 5 years. Okay. Carl's asked, if I take flexible retirement, this is a good question, reducing my IRAs by at least 20%, can I access the lump sum tax-free of my AVC? Right, okay. So flexible retirement, it's not a contractual right to do this, but this is where members take all or some of their LGPS benefits up to that point and then can come back the following week and start afresh and become a member of the scheme again. Here's my biggest steer, because I'm not allowed to give you advice, but I've seen when people have got this wrong with flexible retirement. Often, it does depend to what extent you are stepping down or whether you're fully taking all your benefits you built up to that point. But if you're taking a good old chunk, if not all of your LGPS benefit on flexible retirement, that is your golden opportunity to take your AVC back entirely as a tax-free lump sum, because it's going to be 20 times whatever the pension is taken at that point in time. Because if you don't do it, because I remember a lady a number of years ago, she'd been doing her AVCs, had flexible retirement, and she actually took all her pension up to that point out, but she didn't take her AVC at the same time. So she cashed out her LGPS pension. Then she came back, the following week, started again. Oh, I'm a new member of local government, and I'll start to build up my main scheme again. And oh, by the way, I've got this quite large AVC as well because I didn't take it at the same time. And then when she retired 2 years later, she said, "Oh, I want all my AVC as tax-free cash, please." And then of course it got into an awkward conversation as well. You can't do that, because you can only take 25% of the current LGPS membership. And because now she'd come back part-time, she'd built up a relatively tiddly LGPS pension. So when you worked out your 25% number, it was much, much smaller because you weren't leveraging a big pension now, because she'd already cashed out a pension and she didn't take her AVC at the same time. So be very careful, Carl, in terms of your extraction. So the answer is you can take it all tax-free, but be careful in terms of if you're taking a big chunk, then that's your golden opportunity to realise your AVC at that point. Because if you've then got smaller LGPS pension further down the line, your 25% is going to be a relatively small number and will threaten potentially how much you can have out of the AVC as cash. Hope that makes sense. And then I think Graham's asked, what percentage of shared cost AVC funds, AVC Wise, how is AVC Wise funded? Yeah, very fair question, Graham. Just to be really clear, we don't manage any money whatsoever. We don't have one penny of members' money. All the AVC money is still invested with Prudential, the chosen AVC provider. So you might then be thinking, well, why is someone on from AVC Wise telling me about all this stuff? So we're employed to help educate you as to how this all works and to provide a digital platform for LGPS members whose employers have implemented shared cost AVCs to facilitate the take up. Okay, and how we're funded is that our professional fees come out of the employer national insurance savings, which are made by members who do shared cost AVCs. Now, what that means for you as an individual is, don't worry, you don't pay anything towards AVC Wise. Yeah, fees are no more or no less as to when normal AVCs and where shared cost AVCs are applied. It's irrelevant that AVC Wise is involved from a member charging perspective. As I said, all funds are still held with the Prudential, who's the chosen AVC provider for the pension fund. So hope that makes sense as well. That sort of more or less concludes all the questions there, folks. So some really, really good ones in there. Look, I hope you get something out of this session, even if it's I'm going to take that annual benefit statement, go away and look at it in a bit more detail. And if I need to speak to West Yorkshire Pension Fund. But I want you to take those hard facts, which are on your annual benefit statement, and then start thinking and applying what I call the soft facts about you. Do you want to work to your state pension age? Have you thought about how much money you might need? How tax efficient have you been? Are you trying to retire early before then? If so, have you got an estimate as to what the hit is in your particular situation? And if you can do some extra saving, and then shared cost AVCs are the absolute logical route to go down because of the tax and NI saving, you can give yourself an extra pot of money, which you can either use as cash or you can use it to bridge a gap if you want to go early. There's so much flexibility of what you do with those things, but having that extra pot will give you more options and will improve your wealth for your retirement. So only remains for me to say thank you very much for joining me this afternoon, and good afternoon.